Hey traders, it's Pippi with Simple Trading Plus. In today's short video, I'm going to go over a very simplified version of risk management when trading the Forex market. Let's dive in. So what is risk? Simply, it's the amount of money or the percentage of your account you're willing to risk on a single trade. Another way to say this is how much money you're willing to lose if your trade hits your stop loss. For example, if you are trading a $1,000 account, risking 1%, you'd be risking $10. A $10,000 account, risking 1%, you'd be risking $100. $100,000 account, 1% risk, you'd risk $1,000. And you might say, step back, Jack, that's too much for me. And okay, you might be right. 1% might be too much for you. So here's what 0.5% would look like with those same three account sizes, 5, 50, and 500, or even 0.25%. If you went down to 0.25% on those three account sizes, it'd be 250, 25, and 250. You can even go lower than that, whatever you're comfortable with. In the last video, we talked about what gives value to a pip. Remember this? Lot size gives value to the pip. This is important. So, we put it all together. We use risk percentage and stop loss to determine our appropriate lot size. What we want is for all of our losses to match our risk percentage. So, say we're risking 0.5% on our $1,000 account. That means we're always going to be risking $5. If we have a trade where we're using a 5 pip stop loss, here's our lot size, 0.1, which is $1 a pip. But if we have a 10 pip stop loss and we still want to only risk 0.5%, which is $5, we're going to risk 50 cents a pip, or a lot size of 0.05. 15 pip stop loss, we're going to risk 30 cents a pip, or a lot size of 0.03, to keep our loss around the same $5. 25 pip stop loss, we're only going to risk 20 cents a pip. So our loss would still only be that 0.5% risk, or $5 on this $100,000 account. So let's look at the math. For those of you who want to understand the math, it's the account balance times the risk, percentage equals risk. You take your risk, divide it by the stop loss, and that equals the dollars per pip. Take the dollars per pip, divide it by 10, and you get your lot size. Here's what it looks like with numbers in the formula. $100,000 times 0.5% equals $500. $500 divided by a 5 pip stop loss equals $100 per pip. 100 divided by 10 equals 10 lots, which is $100 a pip. Don't worry if that was too complicated for those of you who don't want to do the math. I don't do the math. I use a cheat sheet. So don't worry, there's an app for that. And it's right here. You can go to simpletradingplus.com and download the simple lot size cheat sheet. It's simple to use. Right here, you just enter your risk percentage and you enter it as a percent, which means you need to use the percent sign. You can see that if you enter your account value and your risk percentage, you look up how many pips your stop loss is going to be. Maybe you have a 10 pip stop loss. You know that your lot size needs to be 0.49 to keep your risk or your loss at about $50, which is 0.5% of $10,000 account. So, when we're talking about risk, there's nothing wrong with starting out small. A good rule of thumb is if it makes you nervous while you're trading, you get butterflies in your belly and not the good kind, you're risking too much. Listen to that inner voice. Another thing you can do is trade in demo to eliminate all risk and gain confidence. You'll still experience some of the emotions of trading with real money, and it'll get you used to uh, what those emotions feel like when and if you ever decide to trade real money. And it's important to start small and build your risk tolerance to a comfortable level for you as your confidence increases in your trade plan and in your trading. As always, guys, feel free to reach out to us at simpletradingplus.com. We'll see you on the next video. Thank you.